Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today's topic is the diversity of global companies. Michael, this is your topic.
We live in Australia.
We do.
We work in Australia.
That we do. Some harder than others, but yes, we do.
And most of us own property in Australia.
Yep.
So some would say we are triple exposed to the Australian economy.
Yep.
Because if there's a downturn in our economy, we grow at a much slower rate. There's a shock to our economy that doesn't occur to the rest of the world, or to the rest of the, or to the majority of the rest of the world.
Yep.
Then we're potentially exposed from the point of view that our jobs
are at risk. So our main source of income is at risk. Our property that we own, which is mainly the main pool of buyers for Australian properties, other Australian purchasers.
Yep.
And so if there's a downturn in people's access to finance or willingness to spend money on property, that normally will be a bit of a hit to Australian markets. And also, and this is, I guess, one that's more hidden, we've talked about, whether it's through superannuation or whether we have investments in Australian companies in our own name or through super. We are shareholders in Australian companies, which again sell their products and their goods and services to Australian consumers primarily. So this is sort of what you're talking about is for the average Australian. There's a triple exposure there. Our retirement savings, our super, our other investments tend to be primarily focused on Australian companies or Australian assets. Our housing and potentially some of our investment properties and that kind of thing, it's in the Australian property market. And our main, I guess, source of income while we're working, our wages or salaries, or if you're self-employed, your business income, that is, again, predominantly based on the Australian economy, and the strength of that is the likelihood of that continuing. And so this is something that we've obviously talked about and we've thought about at length, is that, and a point you sort of just touched on before we started recording here, is that it's when we think about diversification, we often think about being diversified within Australia. So I want to own, a share, a part of the top 200 companies in Australia, or I'm going to own a property in Townsville and an investment property in Brisbane, or I'm going to, have a job here and a part-time job here, or I'm going to have a business that has 200 different customers that are all Australian. It feels like we're very diversified, but in a lot of cases we really aren't.
Yeah, look, we potentially susceptible to a Australia-wide shock.
Yep.
And who knows how that might happen, and it may never eventuate. Let's hope it doesn't eventuate in our lifetimes. But we're certainly no geographical region is immune to something like that.
No.
So if that was to be the case, look, we play through scenarios. How would we diversify away from that, and how would that work? Global companies offer diversification away from Australia, and we're not here to talk about how many of them or what types of them or anything like that, because we're not giving you advice. But we're just making the point that global companies offer diversification away,
and I think that's
from Australia.
That's a good point. Is that global companies in particular, so owning shares in global companies is a very simple and very easy way to gain exposure to other markets, and to gain exposure to a lot of other markets very quickly. So again, to follow that example of if we said we want to be, we don't just want to be exposed to the Australian economy and Australian markets, we're going to go and buy a property in the US, for example. We've sort of just traded the risk to one economy for another. So if there's a downturn in the US economy, for example, we're wholly and solely invested in that through that property. So the point that we're making here with these global companies is that if you think of a company like Amazon, for example, they're headquartered in America, but they do business all around the world. And your biggest and best companies around the world, regardless of where they're headquartered, they do the work of the diversification for you, because they have, not they're headquartered in one country, they have offices all throughout the world. They have employees and staff all throughout the world. They have customers and consumers and clients all throughout the world. They have people exposed to different economies, different currencies, different perspectives, different everything. And so I think this is where we've just sort of said global companies offer that, is that I think that people think of all companies as kind of the same, and that's sort of makes sense in a way, because you look at share market prices and people say the share market went down. There is no one share market. There are hundreds and thousands of different companies that are all doing different things over time, and we lump it all in one category. But the point you're talking about here, that the risk of having everything tied up in Australia, is the simple and quick way to diversify out of Australia is to own overseas companies.
Yeah, and you can do it quite easily, and you can do it quite cheaply.
Yeah,
I mean, you can, and again, without digging too far into the weeds, the methodology of this, you can own. It's not uncommon to be able to own the largest 1,500 companies around the world, which is an index that you can track called the MSCI World Index, ex-Australia, so they strip Australian companies out of that, and you can do it really cheaply, because some fund managers out there can do it for 20 basis points, which is basically
0.2%.
$2,000 per year per $1 million that you have invested. So
so that's a good example. Like
really, really cheap. Cause basically, what they're doing, if you think about it, they're actually converting your Australian dollars into all these foreign currencies, going out there and buying. Holding those companies for you and reallocating.
Not only do you get the fund manager doing the work for you for $2,000 a year, so you pay $2,000 a year to get $1 million invested in overseas companies. So you get spread out across 1,500 biggest companies in the world. Those 1,500 companies, as we just touched on, they're doing business all around the world. So it's basically, by virtue of just that one fee of that $2,000 a year, not only do you get spread out across 1,500 companies, you get spread out across, it's basically like a web all around the world at that point in time, where I'm sure that within that 1,500 biggest companies in the world, they would be doing business in every single country all around the world, and in every different industry to some degree all around the world. So
and look, I like to think of all the countries around the world as a football competition. And or any sport that
I love the analogy that you go on here, where I'm going, where are you going with this, mate?
What it is, there's no matter how strong the teams are in any competition, there is a winner and there's a loser, and there's someone that comes second, there's someone that comes second last, and there's someone that came in the middle. So you can consolidate from 30 teams down to 10 teams for a Super League. There's still going to be a loser in that. You know what I mean? So. The way that I look at it is that countries and economies are like teams in a football league. And any given year, there will be a winner and there'll be a loser. There'll be some that underperform because other countries or economies have come in and taken some market share. And there'll be others that perform really, really well. So to be truly diversified, and our theory is the more that you accumulate, so the more retirement savings that you have, the less risk you want to take with that. Therefore, the more diversified you want to be with that money. To be truly diversified, if you are invested into companies all around the world and a big spread of them across different economies, and you're going to be almost as diversified as you can be. So without looking at all the permutations of this, if you were invested in the largest 1,500 companies in the world, you are very, very well diversified. It's really, really hard to be more diversified than that. It's again not saying go and move money into this, and this will suit everyone, because it won't. It's general. This is a general statement.
But I think that
it's you are diversified. We're talking about diversification here, not rates of return.
No, it's not to say that global companies will outperform Australian companies. It's just from a pure risk management point of view. If you can minimise the impact of the Australian economy performing poorly relative to other economies, that has to be taking some risk off the table there. So, and I think the point of this, I guess we sort of have glossed over this at the start there, but I think you raise a point where we don't even realise the amount of risk that we're taking on by only being exposed to the Australian economy. And so there's a thing. I know you love all these different biases and cognitive things that I come across, but this is a known thing in portfolio management called the home bias, and it's not to say that just Australians do this. All countries around the world, what you find is that the citizens of those countries are overly exposed to the they basically invest more in the companies in that country compared to other countries. Now I'm probably making numbers up here, but I think there was something like Australian GDP is 2% of the world. So based purely on that, you would think that would be the starting point where we should be going, right, we should have, and again, this isn't advice saying you should have 2% of this at all. It's just that if we were completely rational human beings, what would happen is that we'd go, right, there's all these companies all around the world, 2% of the output of them is in Australia. Maybe that's the starting point of how much you should have invested in Australian companies. We don't tend to do that.
No, we don't tend to do that.
Across the board, we go, and there's a couple of reasons for this bias, and I've done a bit of research on this, is that one of the key ones is that we feel comfortable with, in the same way that people tend to be, we would say, exposed too much to residential property. The reason for that is because it's something they can touch and feel and understand very simply.
Yep. The
reason why we're exposed, we would say, too much in Australia to just Australian companies is that we know these companies. We know them. We've done business with them. If I own shares in NAB and I drive down the street and I see a NAB branch, it's sort of comforting to me to go, oh, okay, well, that's my money hard at work for me. Those bank tellers are sort of working for me, making deposits. If I own, shares in a bank in Sierra Leone, I got no idea what's going on there. It doesn't make me feel comfortable to know, okay, that's where my money is tied up and that's what's going on there. So it's a bias. It's a known thing all around the world. It's not just an Australian thing, but it is a really interesting when economists study this, because they go, why should that be the case? If you're a citizen of Germany, that shouldn't mean that you're any more invested in German companies than a citizen of Australia or of the US or anything like that. But you tend to find that all around the world, our focus is too narrow just on the companies and on the economy that we're exposed to at the moment.
Yeah, no, I have read little bits about that, and I believe it is a thing, of course. So if you look at the way that people tend to invest, you can see it.
Yep.
Everyone listening would be able to think of examples instantly.
Yep.
Of people that they know that bought an investment property right beside them.
And they kind of and that's exactly the same thing, because they go, I know there's the house, I can see it. There's a feeling of control, even though there maybe isn't any more control than owning that property halfway around, across the country. So I thought we'd touch on the benefits and then also the additional things to consider, which there are some as well. So the benefits for me are diversification. So it's just being more diversified. There's part B of that diversification, and this comes down to a style as well. So there's two ways to be invested to overseas companies. One is what they call hedged to the Australian dollar, which basically doesn't allow for currency fluctuations to affect your investments. The other way is to be unhedged to the Australian dollar, which means that currency fluctuations will affect your overseas investments one way or the other. Now, the only way I can explain this is to use a real example. Yes.
And anytime you invest into overseas companies, what you're essentially doing is you're taking your Australian dollars and you're converting it first into the overseas currency before you buy those companies. Now, if we take just the relationship between Australia and America and our currencies as an example. Back in 2013, if I converted $100,000 of Australian dollars into American dollars, I got 1-for-1 during parts of 2013. You can remember, I'm sure, that the dollar was on parity with the American dollar at that stage. So basically what happens is I convert $100,000 of Australian dollars into $100,000 of American dollars at 1-for-1 back in 2013. Now, ignoring what the companies did that I invested into over there, what happens now, because our dollar has fallen in relation to the to the American dollar, that $100,000 of US dollars that I now have since 2013 over there actually converts back into around $135,000 Australian dollars. So I've actually made a 35% rate of return in the currency movement.
Yep.
Now, the reverse of that is true as well.
Yep.
If our dollar strengthens or had strengthened in a similar fashion, then our overseas investments in US dollars would be devalued.
Yep.
Here's our school of thought.
Yep.
Our school of thought is that we're doing this for diversification.
Yep.
So what we want to protect against, because we live, work and own property in Australia, we want to protect against the shock to the Australian economy more than anything if we're going to do this. Our thoughts, Dallas, personally, are to be unhedged to the Australian dollar, because what we want to happen is that if there is a shock to the Australian economy, this is our theory, and it's not necessarily true.
If there's any economists listening to this, we know this isn't quite as simple. It's a bit like, we say, it's not as simple as this, obviously. But if there is a shock to the Australian economy or an extended downturn in the Australian economy, the theory here is that the Australian dollar will weaken over time.
The Australian dollar will weaken over time. And in addition to that, the overseas companies that we're invested into will generally grow at a faster rate than the Australian companies. So we actually get a twofold return then, if that's the case. So basically what happens is that our overseas companies grow faster, our dollar devalues, which means our overseas companies effectively are valued at a higher amount converted back to Australian dollars. So that's the benefit. That's the benefit. The diversification benefits there. Now, like I said, the reverse of that is true as well, and a couple of additional things to take stock of. Currency fluctuations. So this is also a downside. So we see it as a plus, but it's a downside as well. If unhedged the Australian dollar and our dollar strengthens in relation to other currencies that you're invested into, then your overseas companies are actually worth a lower amount when converted back into Australian dollars. Now you can avoid that with hedging, but that adds extra cost, and we think
and that's, I guess,
that extra cost isn't worth it.
It's an interesting one, the whole currency fluctuation thing, because again, it's not as simple as this, but in very broad terms, where we're talking about if the Australian dollar was to strengthen, generally that would be on the back of a very strong Australian economy. And so you go, if the Australian economy booms and the portion of our money that we've invested in overseas companies becomes less valuable, to me that's kind of one of those things where you go, when that happens at a time when you can most afford it, if that makes sense. And that's kind of what we're talking about there with the diversification here, is that, again, it's not to say that overseas global companies are better than Australian companies. What you're really looking for here is, especially in retirement, what you don't want is, you don't want all of your assets performing poorly at the same time. In a perfect world, you want a portion of your retirement savings, if a portion of that's going gangbusters and growing and going up and up and up, it's sort of okay for a portion of it to be lagging along behind the scenes there, because you can basically take a bit off the top of your winners. Now, what you don't want to do is, and then what will happen is, over time, the theory is that the portion of your retirement savings that has grown like mad, and you've been able to take your income out of that winning portion every year, you've given that the portion that hasn't returned as well, you've given it a chance to pick up over time. At some stage, there may well be a swap there, and the lower returning asset class will start to perform better over time. And again, this is all very broad strokes, but the theory there is that you want something performing reasonably well at all times, if at all possible. And so that's where greater diversification across global companies and global currencies is the twofold effect of that tends to be useful, because you've sort of got two chances for things to be going up at a time when the Australian economy weakens the most. So
yes,
it's again one where if you want to get in the weeds on this, there's probably economics podcasts that do a much better job than us of explaining this. But it is it's an interesting point when it comes to portfolio construction, is that if you could have the choice between two asset classes that are their correlation is one, they're both going up and down exactly the same, or you could have them where when one goes up, one goes down. You would rather have them be inversely correlated, one going up, one going down, so that you've always got something you can take your income from throughout retirement.
Yeah, and it's always interesting to read about correlation, because it's such a theoretical thing.
Yes.
In reality, it doesn't exactly exist like that. But
what has been correlated in the past doesn't necessarily mean that it's going to be correlated in the future, or vice versa. Or
it's the only way that you can act is based on what your theory is and what you think is going to happen.
Yeah.
The other thing to take into consideration with global companies compared to Australian companies is there's no franking credits with global companies. So, look, if we could stand here today and said, over the next 30 years, Australian companies are going to do 8% per year exactly, and global companies are going to do 8% per year exactly, and in 30 years' time, they're going to be in exactly the same position as where they are now. So if we knew that with assurance, which we can't, and no one on earth does, but if we knew that with assurance, we would put everything that we own into Australian companies.
Yep.
The reason being is that Australian companies come with franking credits. Without going into a detailed explanation there, that adds somewhere around about a 1% extra benefit to the performance of Australian companies if you add in the tax benefits that you get with that.
Yep.
Not exactly the same for everyone, but it's not a bad average to use. So if that were the case, 8%, Australian companies with the franking credits added in actually account for about a 9% after-tax rate of return. So, we would go all in on Australian companies in that situation. I mean, we don't know that. We don't know that. So, it pays to be diversified. I mean, everyone needs growth assets, generally speaking. Otherwise, they run out of money too quickly. It's you want to be diversified and you want to have some cash as well. But I mean, in this scenario, we're just looking at the differences between Australian companies and global companies. We would say any well-diversified retirement savings portfolio should have both. A healthy mix of both.
And that's, I think, the broader message here, which we've touched on before. I can't remember now, some podcast that I thought it was a really clever title about you don't necessarily want a fantastic outcome. You want, in your retirement savings, you want the least bad outcome, if that makes sense. So again, if you had every dollar that you ever had invested in Australian companies in 30 years' time and the Australian economy had gone gangbusters the whole time, you'd be really happy about that. But it doesn't necessarily mean that your retirement was that much better. But if you are only invested in one asset class and that goes poorly, the bad outcome is far worse than the possible benefit. And that's kind of where diversification, the saying in a lot of this sort of stuff is that diversification is the closest thing to a free lunch you can get, because you're basically trading off some of the potential gains that you wouldn't necessarily really get any lifestyle benefit from, to reduce some of your downside risk of what's the worst case that could happen in the Australian economy, and how do I protect myself against that. So that's sort of the way that I think of it, is that you're not, with all of this, any sort of diversification play, you're not doing it to get a better return. You're doing it to minimise the risks of a bad outcome.
Yeah, absolutely. Like, I mean, it would be ludicrous if you, again, using the football team's analogy, if you look at the English Premier League and try to pick, or the NRL or whatever it is, and think that you could consistently pick the winner of that competition every year for 30 years. What you want to do is avoid being coming last
Yes.
every year for those 30 years.
That's
You know what I
right.
mean? You want to
Yeah.
be sitting somewhere in the middle,
Yes.
diversified,
Yep.
giving yourself a chance to
Yep.
make the semi-finals. And
Yeah.
It's one of the, I mean, it sounds absurd if you were. That's, I guess, the way that some people treat the performance of their retirement savings. They think that they have to actually
Win the
outperform
comp
every
year.
single year, and it's I mean it's absurd. It's absurd to think that you could do that.
Yes.
You just cannot do that because like no one on earth can do this. So diversification for me is about saying that you've been consistent along that whole period of time, and the chance of getting relegated is minimised.
Yep. Yeah, I think good place to wrap up.
Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Money Over 50 financial advisors. We look forward to catching up again soon.